Okay, so in the previous video, what we have done is that we have checked different components and different aspects of perfectly competitive market. In this video, we are going to look at the fact whether or why the energy market can or cannot be perfectly competitive in nature. So we are going to start with this question: why is perfect competition not observed in energy market? So let us start with the first characteristic of energy projects. The first characteristic which prevents it to be perfectly competitive in nature, the market to be perfectly competitive in nature, is basically the indivisibility of capital. Now, what do we mean by indivisibility of capital? Let us start with the following example. So, if you think about the power plants, the NTPC has various power plants, across India, and the oldest one probably is in Singrauli, and the capacity of this power plant is 2000 megawatt. Now this 2000 megawatt installed capacity is actually distributed across 7 units, and each of them has the installed capacity of 200 to 500 megawatt hour. So you can imagine the size of the operation of each unit. Now, if at any point of time NTPC decides to add one more unit to this Singrauli power plant, you can be sure that the size of the power plant is going to be again something in the range of 200 to 500 megawatt and not less than that, if this is a coal fired power plant. I mean, for renewable projects, there are many installations where the installed capacity is much less than that, maybe 15, 20, 50 or so on. So here what we can see is that the capital, you cannot really, when you feel that there is a need, you can't probably set up the power plant in an incremental basis. So you can't say that from 2000, or maybe if we take one unit from 200 megawatt, tomorrow I'll make it 210 megawatt, then the day after I'll make it 220 megawatt. That is not really possible. If you want to make an investment, you have to invest probably on another 200 megawatt project. Okay, so the capital is indivisible in nature. As a result, this becomes lumpy as well. Why is it lumpy? Because you have to spend this money at one time. You have to spend a lumpy amount of money. So the investment is lumpy and the capital is indivisible. So this is one of the most basic characteristics of energy projects, and this is true for any of the energy projects. If you look at the oil fields, you look at the mines, you look at the refineries, the scale of operation is very big. So now what is the interesting fact about this lumpy and indivisible investment in capital? The fact is that you have to wait for a bit in order to understand that there is enough demand that can support your addition of capacity addition of another 200 megawatt, right? So you have to have a clear hint from the market that is telling you, okay, go ahead and go for this addition of capacity. This is the first point of departure from the perfectly competitive market structure. So what we assumed in case of perfect competition was that the marginal cost, if you remember, the marginal cost was smoothly rising. It meant that you can keep on incrementally adding to your capacity as and when you want, right? So that was giving a smooth line. But that is the first point of departure. Here you can't really have a smooth marginal cost curve. If you do not have a smooth marginal cost curve, then obviously you can't equate the market price with the marginal cost curve that you are talking about. If the marginal cost curve is not smooth, then how does the pricing take place? If we are not in a position to equate the price with marginal cost, then how does it take place? Let us start with a situation, and let us assume that this is the power plant that we are talking about. At the initial phase, what we are saying is that P is equal to MC. So initially, there is no demand supply mismatch. The price is equal to MC, which is equal to average variable cost, and the market, the perfectly competitive market, is there in order to supply as much as you want up to point Q star. So Q star actually gives you the initial plant size. So your production cannot go beyond Q star. So that is the only constraint that you face. But up to Q star, your production behavior is just like a perfectly competitive market. Let us start with the demand curve D naught. If the demand curve is D naught, Then you see what you are doing. You are saying that this horizontal line is your long run supply curve of power or long run supply curve of your energy, which is pretty much similar to the perfectly competitive market structure. Then you face a demand equal to T naught. What you do, you decide the quantity to be produced. So the production of energy will be at Q naught. As a result, what happens? There will be some excess capacity. So basically, the demand is not enough to utilize the entire energy generation capacity that you have. So some excess capacity remains, which is pretty much okay with energy in the industry, because energy industry is such an industry that it always has some sort of an excess capacity, because it has also to cater during some contingency situations. So having some excess capacity is not very unusual with the energy market. So up to this point, we don't see any departure from the perfectly competitive behavior. There is no problem with that. The problem happens when the demand increases. Suppose the demand increases to D1. Now, in order to be in a perfectly competitive market structure, the production would have taken place at this point. So this would have been the point of equilibrium, the production would have been here, and the price charge would have been P naught. But the problem is that in the short run, this particular farm or this particular producer of energy or the market for energy, it sees that the supply is not enough or the capacity is not enough to meet the demand, but the demand does not show up as to be as high in order to go for another capacity addition. So what does this farm do? See, the farm anyway cannot produce more than Q star, because that is the constraint within which it is operating. So this has to be on the demand curve and this has to be on this Q equal to Q star line. So the only point of equilibrium that is available with the farm is at this point. If the farm has to bring the market equilibrium at this point, then what is happening? Then there is a departure from perfectly competitive equilibrium. The perfectly competitive equilibrium would have been here, but constrained by the plant size, the market equilibrium is being shifted at this point. If market equilibrium is shifted at this point, then what is happening? The price that you are charging from the consumer, the price that you are, first of all, okay, let me just explain this. First of all, what happens as the price that you are charging is higher than the competitive price, some of the buyers will actually leave the market. The buyers who were willing to buy energy at this price P naught will actually leave the market when the price is increased to P1, right? So you see some of the buyers actually depart the market, and what happens? The price rises to P1. So at P1, it not only covers your average variable cost, but it covers something in addition to that. Because at P naught, your average variable cost was already covered. So at P1, something more than average variable cost that you are earning. Remember, this is not your supernormal profit. Supernormal, you earn supernormal profit only when your price exceeds the total average cost. So which is the composition of average variable cost and average fixed cost. However, you see sort of a ray of hope that you are exceeding your average variable cost. After a few days, what happened? Demand again increases and it becomes D2. Now, the producer has to, bring the price to this level at P2. At P2, the price charge, it not only covers the average variable cost, but it also actually covers the average fixed cost. The moment there is further increase in the demand, then what happens? The price actually exceeds the average cost and the farm will start earning some supernormal profit. Now, once the demand reaches at D2, the other existing farms who are ready to enter the market but were not very sure about the increase in the demand, or think about the same NTPC thinking about the expansion, the signal that they get from the market is that now the situation has come where you will not only recover your average variable cost, the price is so high that you will not only recover your average variable cost, but you will also recover your average fixed cost, if not you earn some supernormal profit. So at this point, at point P2, now new entrants are interested. So capacity addition, there will be interest in the capacity addition in the energy market. So let us assume the capacity addition happens here. So now this becomes the new plant size. So this is the capacity addition. The new plant size is determined at this point, which is Q double star. Now, when Q double star is the new capacity and if D2 is the demand curve, then what actually happens, instead of being at this point at price P2, now the supply has increased, the demand remaining constant, the supply has increased. So the price is going to fall. And the new equilibrium will actually come to this position. See, this is the perfectly competitive equilibrium position. So whenever you are on this P naught line, you are on perfectly competitive equilibrium. However, the moment you are deviating from this line, you are actually deviating from the perfectly competitive equilibrium. So what is the movement of price in this kind of a scenario? Initially, you moved from here to here, price remaining unchanged, the quantity increased, price remained P naught. Then there is a sudden hike in the price increases up to P2, and again the price declines. Okay, so you are on the perfectly competitive outcome up to your full capacity. Then there is a departure from the perfectly competitive outcome. Then you again come back to the perfectly competitive outcome. Probably you will go up to this point, you exhaust all your capacity, and again there is a shoot up in the price. So there is a volatility in the price that you can see in the energy market, which actually compels it to deviate from the perfectly competitive outcome. So this is one reason, because of this indivisibility of capital, because you can't go on incremental increase in capacity addition, you have to do it in a lumpy manner. This actually forces the energy market to deviate from perfectly competitive market outcomes. So how does the trajectory look like? The trajectory looks like this. Initially you follow this path, then the price goes up, then you follow the demand curve, the price comes down, then you again be on the perfectly competitive path until you exhaust the new capacity that you have created. Again there will be a price shot up, again this will start continue falling following the demand curve. So in this kind of situation, you see when there is a demand boost, the price actually increases. Then there is a capacity addition and the price again declines, it remains constant. Again the price increases and then falls. Now this is called a boom bust cycle, which is very common in case of the energy market. And in the price mechanism of energy, just looking at the boom bust cycle, it is often determine what is the situation in the energy market, whether it has a very high supply as compared to demand, or whether it has low supply as compared to demand. Let me give you an example from the natural gas industry. So this is just from the internet. If you go to this website, you will find the whole report. So if I just read it out, it says that 2007 was the year that natural gas exports officially exceed imports for the first time since 1957 in USA. This is of course due to the shale boom and increased use of natural gas. Now see what happened in US. The natural gas was discovered. After the natural gas was discovered, they not only started producing and supplying natural gas, they also encouraged people using natural gas. So both the supply as well as the demand has increased. Now if the demand increases, then you have some motivation for capacity addition and more exploration and more production of natural gas. And this is what has happened in US, and this report is saying that in 2007, for the first time, US was reported to be the net exporter of natural gas. So the export actually exceeded the import. In earlier phases, the US used to import natural gas from Canada and other countries. However, the interesting line is this. It also says, despite the rosy prediction of Shell, ExxonMobil and IEA and others, the commentary for months has focused on a global LNG glut. Prices will stay low and producers ranging from Qatar, Australia, Russia, Iran and US will scammer on the market share and chase consumers by offering the most competitive deals, driving the price down even further. Statoil, in its annual outlook, warned that LNG was in the midst of the classic boom-bust cycle, with the final result being the transition of LNG into a more typical global fuel source. So here you see what they are trying to say, They are trying to tell that now you have this demand curve. This demand curve has been discovered. Now everybody is trying to supply LNG. There is a glut of supply in energy. The market is flooded with LNG supply. So now probably the path of LNG price will follow here. So that is why they are predicting that the price of energy is likely to come down in near future because of this classic boom bust cycle. So this is one of the classical examples how the pricing of the energy market works. The second point that we want to talk about, which again forces the energy market to deviate from perfect competition, is the asset specificity and capital intensiveness. So this is a little different from the indivisibility of investment. There we said that you have to make a big investment. You can't make incremental investment. The capacity addition cannot be incremental. It has to be lumpy in nature. Here what we are saying that once you have spent money in buying some asset which are important in the production process of energy, that asset cannot be deployed anywhere else. For example, you think about the machinery or you think about the equipment that is deployed in the power plant. You suddenly can't take them out and bring them to the oil field. Or you think about the drilling equipment that are used in the oil field. Once they are bought there, they have to be used in the oil field only. So the alternative use of the equipment that you have for these kind of projects is very, very limited. So it says that your money is stuck for a longer period of time, and these are very, very investment intensive projects. So initially you have to spend a huge amount of money which will be stuck with your project and which will have very limited other or alternative uses. So this is one of the very crucial features of energy projects. Additionally, what we also mentioned is that the capital cost, that is the fixed cost, is much higher as compared to the variable cost. As a result, the economies of scale is prominent only when the size of operation increases. So the concept goes on like this. So I have already spent 1000 rupees at the beginning. Now, in order to run the operation, every day I have to spend 1 rupees for production. So if I increase my production, then I will be quickly able to recover my fixed cost, because the fixed cost is what matters. 1 rupee I'll anyway recover. So the variable cost is too insignificant or non-significant with respect to the huge capital cost that they have to incur. Now, if you look at this picture, what makes it clear is that in perfectly competitive market structure, we said that producer in order to maximize the profit will equate the price with the marginal cost. Now, under this situation, so imagine this is the case where the capital cost is really, really high, right? So if the marginal cost is equated with the price, the equilibrium will take place here. So this is where the producer is producing. But what is the objective of the producer? The objective of the producer is kind of to produce as much as possible, as quickly as possible, to retrieve the initial cost. So it wants to produce more in order to retrieve the initial cost fast. That the producer can do if it does not equate the price with marginal cost, but rather equates price with the average cost. If that is the case, then it will be able to produce Q2 amount of output, and this will actually increase the speed of recovery of the fixed cost that has been incurred. So that is why we often say that in the projects where the fixed cost is much higher as compared to the variable cost, it's often seen that the marginal cost pricing principle does not hold. The pricing principle that comes into the force is mostly the average cost pricing principle, and that is also true in case of the energy projects. And this is another reason why it deviates from the perfectly competitive market structure. Now, see, what is the drawback of this whole process? The drawback is that if you keep on indiscriminately producing energy, there is no guarantee that everything will be sold out in the market. So there will be excess capacity, there will be oversupply, this kind of problems will be there. And the market has found out the ways to tackle this oversupply or this excess capacity problem. How have they done so? So one way to do so is through regulation. So through regulation, you fix the price and this is mostly applicable in the electricity sector and the network industries. So the tariff is actually directly linked to the production of energy and the operation of a particular level of asset. So the price that is prevailing in the market, this is the regulated price that will ensure that a certain part of asset cost or the certain part of fixed cost is recovered. At the same time, the running cost is also recovered. So this is a regulating mechanism. However, in those markets where these kind of regulations are not there, the horizontal integration is possible. And this is visible in oil market tremendously. What do they do? If there are more than one producers operating at the same level of efficiency, maybe they are operating for the same number of years with same experience, same expertise and so on, they can go for integration through merger and acquisition, or it can also happen through cartel formation. So this cartel formation is something we'll devote some time on to understand the oligopolistic cartel here. But this is what the oil industry has done. They operate in a cartel. So how much supply they are going to go for in the market, that is decided not by only one firm, but jointly by the major supplier of the industry. So in a nutshell, what we can see from this discussion is that energy projects do have characteristics that actually deviates strongly from perfectly competitive market outcomes. And you can also see this kind of very high fixed cost, this kind of lumpy investment. It also gives a hint that it's not possible for everybody to enter into the market. You have to have huge capital. You have to have certain other characteristics to be an investor in this market. So the number of investors, number of producers, number of suppliers will be limited in the market. So that kind of gives us a hint that do we think that monopoly is a better option to explain the energy market as compared to perfect competition. So this is the end of this lecture. In the next lecture, we are going to talk about monopoly.